Good morning, everybody, and thank you for joining us today. So the presentation will cover a little bit on Migo, although I know lots of you will be very familiar with the trust, but just go through a little bit on what Migo does and how we do it and what we're looking for. Then we'll talk more about what's going on in the investment trust world, which is obviously quite an interesting topic at the moment. And then finally drill down into what's going on in the portfolio. So just as a general overview, to start with, as a reminder, we have a cash benchmark, SONIA +2, and as you can see from the chart on the right, we have mostly consistently outperformed that. Obviously, it's been a tough couple of years over the last sort of 2 to 3 years. We'll talk a bit about why that's been so tricky, but why we're feeling quite optimistic about the trust going forwards. We're reasonably concentrated with 42% in our top 10. Our discount remains pretty narrow, despite the discount problems going on in the investment trust world, and that is a function of the fact that we issue and buy back in order to get the market into equilibrium. So as you can see again on the chart at the bottom on the right hand side, our discount it tends to trade in quite a narrow range. At the end of December, our discount was around 3.7. We have some gearing on the trust. That's a function of the opportunity set that we're seeing at the moment, and gearing is around 7%. We have a redemption opportunity every 3 years. Our last redemption opportunity was last year, so there's another 3 years before we'll go through that again. And we have a very reasonable fee on market cap rather than NAV. So onto the team, which will be very familiar to you. Obviously, my name is Charlotte Cuthbertson. I'm fund manager. I run it with Nick Greenwood, who was manager at launch, and we have a wider support team from our move to AVI, and the names are on the screen with you. And in a nutshell, what does Migo do? Well, I'll pull out a couple of these things which I think are the most interesting. And the first one is that we're often used as a one-stop shop for closed-ended fund access. The closed-ended fund universe is very wide, lots of different asset classes. There's a massive opportunity set, but often investors don't have time to do the digging and the due diligence and the hard work looking and lifting the lid of different investment trusts and working out what's going on there. And so Migo provides what we consider to be a one-stop shop to really interesting opportunities in the closed-ended fund world. Uncorrelated in idiosyncratic sources of return. We don't have a lot of correlation to wider markets because our opportunity set often when we're looking for these catalysts, once these come through, we tend to see, can see quite lumpy returns. And I think on the next slide, we have some longer term performance, and that's really highlighted that there'll be sort of years where those catalysts come through and you see these, these big returns. So it does mean that we're not necessarily as correlated to major indices. And finally, we are looking for those discount opportunities, and both myself and Nick have been specialising in this area for a long time. As I said, you can see the long-term performance of the trust, and you can really see how returns come through over time. As I said, it's been a tricky 2 to 3 years, mostly because of what's been going on in the investment trust world. But as I said at the beginning, we are feeling optimistic about what's to come in the future. One of the big changes for the trust over the past couple of years has been our move to AVI. This gives us, a considerable amount of additional resources. The team is still myself and Nick. We're the ones running the portfolio, but having that, extra resource within the firm has been, enormously beneficial. And moving on to the next slide, I think number 4 here is probably the point that is really enhanced by our move to AVI. AVI has a really long history of engagement and activism, and where we are in the investment trust cycle with discounts at extreme levels, engagement activism is very, very important. I imagine there may be some questions around that at the end. But having, AVI's expertise on this has been a real boon for the trust, and we think that it will be, a helpful source of returns going forward. So what is our process? What are we looking for? How are we doing it? We've always been looking for discount opportunities, and there's a raft of opportunities at the moment. So we're looking for those discounts, but we also have to like the asset class, and the next slide will really highlight why that's important. What we're looking for is a rising NAV and a narrowing discount. That's the combination, the double whammy, where you see those returns. And we have to have confidence in the NAV, and we have to feel that we've done the due diligence, and we've done the work, and we've done the in-depth research to really understand what's going on, at the net asset value level, and what's going on in these underlying portfolios. We've seen with the raft of alternative asset classes within trusts that sometimes those NAVs can not necessarily, what's being put out by trusts isn't necessarily, a fair reflection. So we do an awful lot of in-depth research, and finally, around 40 to 50 of these trusts make it into the portfolio. And this really highlights why it's so important that we have to like the asset class. There's plenty of investment trusts that trade on large discounts, and will continue to do so. And there's, and there's two different ways to narrow discount. It can be that the share price going up and matching the NAV, or it can be that net asset value falls down to the share price. So it's really important that we're looking for the first and not the second. But this is, the source of returns and how we run the portfolio and what we're looking for. So if you heard us present this time last year, we thought it might be interesting to see and to talk about what were the things that we were talking about this time last year, what have come through, and what has maybe hasn't come through in the same way. So there was sort of three things that we thought were going to be pretty positive for trusts last year. Trusts had had pretty major headwinds with the ongoing charges fiasco. Trusts were needed to put out much higher charges than open-ended vehicles. They were caught up in this EU regulations. And so so areas like private equity, something like Oakley Capital, had to put out a very high ongoing charge, which meant that it was a major headwind for people to invest in the sector. So we thought that last year that this would be, we saw that the pressure of lobbying. We thought that we would see a resolution to this, which would be not a silver bullet, certainly for people to coming back to invest in trusts in great swathes, but would remove a pretty tough impediment. And we thought that would be very positive. So where are we in 2025? The FCA did declare forbearance so that trusts would no longer have to issue these costs, which was very, very positive. What has happened is that there hasn't been any confirmation of what charges trusts could and can and should be putting out in lieu of the original KID documents. So some have been issuing zeros, some have been putting just management fee. There's very little clarification on what that looks like. Platforms have found, platforms are pushing back quite hard on trusts putting zeros instead of having a number for their charges. So there's a lot of confusion, and there's, and we're waiting for some clarification. And we think that should be forthcoming at some point this year, and that would be, very helpful to kind of put this issue to bed, level the playing field, and for people to feel that more confident in buying trusts, and that they know what charges that they're going to be able to put through. Secondly, rising interest rates had been very, very tough for the whole of the investment trust sector, particularly in areas in infrastructure and areas that had, asset classes that had been launched in order for trusts to be producing an income. when many investors were sort of income starved. Rising interest rates meant that gilts were now yielding attractive levels. Lots of investors moved back to more traditional sources of income, and share prices fell considerably in these sort of alternative areas. We have seen some interest rate cuts, but inflation has been considerably stickier than I think many of us were expecting. And particularly towards the end of last year, with the election of President Trump and the Rachel Reeves budget, we're seeing those inflationary pressures and those and nerves around inflation remaining. We saw yields rising again. So it's been a small positive, but it's certainly not been the major tailwind that we would have expected and hoped for this time last year. But we do think that our portfolio has some exposure to interest rates because we do have some infrastructure, renewables, etc. But for us, the main catalyst is not necessarily interest rates falling, but will be corporate activity, and we'll talk a bit more about that going forwards. And we hoped finally that there would just be an increase in investors in investment trusts. We thought, we hoped that with the ongoing resolved with interest rates falling, that this might prompt a little bit of people returning to the industry. And I think what we've seen is people still holding off. The people that are coming in and buying tend to be activist investors because the sector does look very cheap. And so the catalyst, instead of it necessarily being a recovery, has moved more to activism, engagement, and corporate activity, which I think we were. I think that was something that we were very cognizant of this time last year, but has just grown and grown and grown over the past year, and it's now it's now a very interesting opportunity. So you've probably seen this graph before on the sector-wide discounts. We saw a little bit of recovery from the sort of the peak discount that we saw end of 2023, but discounts across the board still remain very, very wide. This does mean that that things are trading very cheaply. It will therefore provoke some buyers to come in and take out assets and take investment trusts off the market. We are seeing that there is still an oversupply of investment trust shares versus the demand that's in the market, and until that's resolved, we don't think that that investment trust discounts will narrow particularly, but we do think increasing in corporate activity will be a big catalyst for that to happen. So why now? Why do we think that it's interesting? Interest rates have come down. I mean, this is a bit of a bit of an unusual one in that yes, they have come down, but we're keeping an eye that it's not necessarily going to we're not necessarily going to see the cut this year that we would maybe have expected, but we think it's unlikely that interest rates are necessarily going to go up considerably from here. Corporate activity, I've mentioned it for the last couple of slides. This is probably the real opportunity set. It's the real catalyst that was gonna come through and help extract value. We've been saying it for a couple of years. It's been a very tough time to be running a trust of investment trusts, but actually it has created a huge amount of opportunities, and we do think that we can see brighter days ahead. So something that did come through last year, and an example of our process of how we invest is Schiehallion, which with a Baillie Gifford run trust, is a Baillie Gifford run trust. This really suffered through rising interest rates. We saw a lot of trusts in that private equity growth segment really struggling, falling onto very large discounts as interest rates rose. There was a perception that they had a lot of very cash-hungry young companies, and that they would struggle considerably in this new environment. But actually what we saw is Schiehallions net asset value holding up very well. And as you can see over the year, it made steady progress. As it made steady progress, and as investors got more comfortable that there wasn't going to be big write-downs in the portfolio, you can see over the period that there was an increase in investors coming in, and we sold out at the end. We sold out of our position at the end of last year, and obviously have made a very, very healthy return on that investment. A couple of other things I'd pull out, sort of examples of corporate activity. We had Aberdeen Property Income, which was a successful investment in terms of we could see after the failed merger with Custodian REIT that would probably that trust would almost certainly be wound down. Subsequently, it was. And then Atrato On-Site Energy was another example of something that was taken off the market. So despite the fact that last year wasn't as positive as we were particularly hoping, there were instances where we saw these successes and we saw these catalysts coming through. So where's the portfolio at the moment, and where do we see the returns coming from in the future? This is the top 10. The average is around 30%. So again, still at very historically wide levels. This average around 33 to 36 sort of March last year. We have seen a little narrowing of the discount, but it is still at historically wide levels. If we look at this set of holdings, there's a considerable amount of these that are either in wind down or going through a strategic review, or selling off assets and buying shares back. So PRS REIT is going through a strategic review. That we believe that portfolio is likely to be sold. Phoenix Re Deutschland is breaking up their portfolio and selling it off. Aquila European Renewables, again, that trust is in wind down. Both Georgia Cap and Chrysalis have been selling off some of their assets and buying shares back. So all of these investments, we can see where the catalysts are, and if you just look at the numbers, we think there's a huge amount of opportunity there. So what have we been buying more recently? In the purchases, as you'll be able to see, there's a couple of real estate. We think this is a particularly interesting area at the moment, PRS REIT and Life Science REIT. We had some, as I said, some successes with Aberdeen Property last year, and we think that these two are very interesting opportunities. Tufton, again, that share price has come back a bit more recently, but the announcement of some capital return last year was very positive. And then for Augmentum and Baillie Gifford, Nippon, these are areas that have been particularly beaten up in the fact that, for Augmentum, it's growthy fintech. Investors are very nervous around it. We actually think the underlying portfolio is very interesting. And with Baillie Gifford and Nippon, it's an area that is just very overlooked and unloved in terms of investing in Japan at the moment. Activism is sort of the only game in town. People have gone with the weakness of the yen. People are focusing on exporters. Baillie Gifford's, Nippon's portfolio is focused on domestic growth, which is currently trading at historically low valuations in comparison to the wider market. And then in terms of what we've been selling down, we've been streamlining the portfolio a little, and trying to put more of the money in our best ideas. Some of these sells. So if I look at Intercapital Growth, that was a particular success for the company, and we sold it at par, especially with the Indian market looking pretty fully valued. Some of the others, less so, but we think that we've through the process of streamlining the portfolio, we think that we've got a really good portfolio going forwards. Many of you have probably seen this slide before and heard my joke about an eye test. but it's worth reminding you what we've been doing with the portfolio and where we were sat, in 2022 and where we are now. Considerable amount of cash was built up in 2022 after the heights of 2021, where we felt like the market was very fully valued and overvalued, and so we were feeding that cash out into the market. The alternative segment, that's that dark blue chunk, was very, very small. These trusts were still trading at par or above, and we therefore it was an area that was not of interest to us. Fast forward to where we are now, alternatives make up a good portfolio, and we've also increased that section on private equity to include some of those more growthy private equity names, like Chrysalis, Schiehallion, but obviously we sold that out of that Augmentum and Seraphim space. So finally, before we move on to questions, the current portfolio themes I think we've talked about, but I think last year we we're probably sick of hearing us say this now, but it is a very interesting time in trust. Discounts are historically wide levels. They remain in that, but we think that with the increase of corporate activity, engagement, and activism, that actually that should be a real catalyst going forwards to narrow those discounts, and we think that moving forward, we're very optimistic.
Brilliant. Thank you very much, Charlotte. That was very interesting. So we've had a few questions already, but just as a reminder to everyone, please submit your questions using the Q&A function at the bottom of your screens. But to start things off, I've got a question saying, you've mentioned a number of your trusts in the top 10 are heading to wind down. How are you going to allocate this capital?
In terms of the cash coming back and then
I think that's
back to the market. Okay, yeah. Well, I think many of them will return cash steadily. And there's plenty of new ideas, that we have waiting in the wings that where we can recycle that capital. I think it's less likely that these trusts will completely disappear immediately. That's a possibility. But if that happens, there's plenty of opportunities that we can put it in. But for something, say for Phoenix Spree, I think that cash will come back steadily rather than necessarily in one chunk. So there'll be a combination of some that come out in one go, but more that either use that capital to buy back shares or tender offers or such, or steadily hand cash back.
Brilliant, thank you. So I've got a couple of questions around the private equity space. The first one is, what is the opportunity you're seeing in private equity trusts with their discounts around 30 to 35%? And then just another question around that as well is that, what's your rationale behind the sale of Schiehallion and the timing of this?
Do you want me to take
that, Nick? Or...
Yeah, okay.
Yeah.
Private equity, I think probably there's a number of factors there, but probably one of the key factors is it's been hit really, really hard by the OCF declarations. I mean, some of them are up around 6 or 7%, particularly the more successful private equity funds that have had big performance fees. You're putting out OCFs inferior sort of 500, 600, 700 basis points. That makes it almost uninvestable for a large stretch of the market who have to then declare those figures into their own product details, making their own products look very expensive. So it's sort of partly a bet on them being totally out of favour, but also the OCF issue getting resolved. And unfortunately, that's dragged on, and the sector has remained on deep discounts. But OCF is probably to our mind the biggest factor. What was the other question?
Schiehallion.
Schiehallion. Yeah, I mean, we went up to Edinburgh to see it. I mean, basically, Baillie Gifford said to us, we're probably in your universe now. You should come up to Edinburgh, and so we did. We looked at Schiehallion, we looked at Edinburgh Worldwide. I think that we bought it because it was on such an extreme discount. I mean, the concern, as Charlotte was saying, was that you've got young, hungry companies looking for cash. And there was a period of time when that was very uncertain, but they come through that. We're trading at, getting on to about a 60-odd discount, and it came back into favour. That screamed up to about 11% discount at one point. I don't think we got out to all of them at that level, but really the main thing was that it was a screaming buy on valuation grounds when we went in, and that factor had completely disappeared because it traded on quite a tight discount, and there was a lot of buying for it. So very often when the right time to get out, when there's a lot of enthusiasm, and that's the very time you can get the liquidity to get out, which is one of the happy accidents of our style.
Brilliant. Just on the topic of private equity again, is Augmentum a corporate activity play, or do you think the discount could narrow organically?
I think that the discount can narrow organically, but we would be engaged with the trust, going forward around, if that discount continues to languish, there's always scope for engagement about, what the trust needs to be doing going forwards. But I think with that situation, some realizations of in the portfolio could be a catalyst for people coming in, and then otherwise, we can engage. There's always it's always sort of two prongs with these situations where they can come back into favor and from good math performance or whatever, and then you also have an angle where you can engage with the trust as well about things that they can do in order to help narrow that discount as well.
I think it's a good example. I mean, we're bullish about the portfolio. What you find with some of these trusts is that the 3 or 4 winners carry on being winners and become ever larger in the portfolio. And Tide, in this particular case, I think is having another funding fairly soon, which it's already about 20% of the portfolio. So fundamentals look good, but it's an interesting example where maybe a year or two ago this wouldn't be an engagement. But I think as we get onto the wider issue what's going on in the trust world, boards now recognise if you languish on a wide discount, you're going to find yourself with problems, and therefore I think boards will, and Augmentum might be a good example, have to find a way of narrowing the discount in a way where they wouldn't have felt the pressure to do that even 12 months ago.
Great. As expected, there is a couple of questions around Saba. This one is, how do you think this will affect Migo? And is it opening any more opportunities for you? And are you looking at the trust that they're going after?
You want to start that one, Charlotte, or shall I go for it?
Yeah.
I think it is the big subject, really. I mean,
it is the big subject. Yeah.
Where do we start?
Yeah. So it's yeah. Well, there's sort of two sides to it, because do we think activism engagement is very healthy in the trust sector? I think there has been a considerable amount of complacency from trusts and boards about levels of discount, and it has thrown a bit of a it's forced trusts and boards to look at their discount policies and shareholders. So I think that's been very useful. I think some of the unfortunately, because of some of the ways that Saba have gone about it, has attracted criticism, which is not unreasonable. So we're not, we're neither sort of, we're not, tying myself in knots here, trying not to to end up in a sort of a Twitter spat, as we've already been singled out by Mr. Weinstein on Twitter. So it's healthy and useful, and in terms of engagement and activism and holding boards' feet to the fire, but I would say that we can't necessarily agree with all of the tactics that and the ways that Sabra have gone about things. Is it useful to Migo? Yes, because I think it shines a light on and it pushes trusts to do better, and to focus on shareholders. But realistically, are we running the portfolio particularly differently? No, we're sticking to our knitting.
I think that there's a point that in the environment, these challenges just aren't going away. So I think there's a good point that anything trading on a 30 discount, and our average is a 30 discount, can't stay that way. Otherwise, they will be on the receiving end of corporate activity. So, funnily enough, right the way in the range, if you own a portfolio of deep discounts, it should be a profitable period for you. Profitable period for owning the trusts. Maybe not so profitable be a manager or people making their livings from investment trusts. But all sorts of trusts will now be vulnerable. There'll be another wave of buyers coming in who have been attracted by, the trust sector is in the paper every day. Other sorts of real world investors will be attracted because there's an arbitrage here. The oversupply situation means that things, trust trade on a big discount. But there is demand in many cases for the underlying assets. So you've got this arbitrage between the problems of the trust sector, but which don't apply to the assets the trust actually own, which in many cases you could sell off at a profit. So yeah, I mean, it's Migo is an ideal way of playing what we're going to see over the next year or so.
Brilliant. So just touching on that a little bit more, question around what your views are with what Savills will do with their stakes in those stocks if they've been voted against. So what's their end goal?
Well, they're not going away, and once you've got an activist with a 30% stake, they'll just keep coming. So they've got to try and find a way of getting them off the register. Yeah, I mean, it'll be ongoing, and probably the next thing that will happen will be demands for tender issues, and maybe the right thing to allow Savills to go. It depends, what Savills want to do, because they do feel a bit. It's difficult to sort of judge that they'll do anything that we would see as logical, because they're taking a totally different approach. Whether they'd want to stay on and be more aggressive than just getting out at a nice profit. So yeah, I mean, I think we're all sitting waiting to see what round 2 is going to be like, but there will be a round 2.
Mm-hmm. Mm-hmm.
As we can tell, there is obviously a few more Sabra questions coming through. Is there any reason in particular why people need Sabra off their register, or do you think it's a positive thing to have them on there?
I think the problem is Sabra could be a disruptive presence that makes it difficult to operate your trust in a way that's helpful for all shareholders. So I think it's important to try and get them off the register, because they have different objectives from other shareholders. There's nothing wrong with what Sabra are doing. They've seen an arbitrage and they're ruthlessly exploiting it. If at the end of the day they put their money where their mouth is and bought 20 to 30% in a range of trusts, it's the fact that if you allow yourself to drift off to a wide discount, this is the sort of thing that happens.
Brilliant. If we move away a little bit from Sabra now, is there any prospect that the upcoming election in Germany could be positive for Phoenix Spree?
Should I take that one?
Yeah, if you want to, yeah.
Not sure. There are scenarios that aren't helpful, because the business of rental property does trigger emotions. So I suspect that if there's a swing to the right, there's not too bad news for Phoenix Spree. Well, obviously Phoenix Spree doesn't really have a long-term future, so we're looking at what the market will do in the short to medium term. I think if the Greens or the Socialists do particularly well, that could be bad news, because you could get some knee-jerk legislation. It's very political, the residential property in Berlin. So yeah, it can make some changes, some benign, some not. And at the moment, I suspect that the most likely thing is a swing to the right, which, if anything, would be good for Phoenix Spree.
Thank you. Sticking on the terms of stock specific, The share price and discounts at HICL and INPP are still performing poorly. Can you see any catalyst for this turning around?
I mean, they're not stocks in our portfolio. They're sort of much more big mainstream infrastructure trusts. So they're certainly not a Migo play particularly. I mean, I think what we saw with Hickle selling their asset and using that to pay down debt and to buy shares back. The problem is that they sold what they could sell, which is one of their best assets. So actually, what you have now is a portfolio that's not, that is actually lower quality. I think they're very much interest rate. They're very, very interest rate sensitive, and I think we were talking earlier about the supply and demand. There is just oversupply of paper in these infrastructure trusts when they were just income producing vehicles, and there's other places to get your income from now. So I think they are very interest rate sensitive, and it will be that sector needs to shrink. So whether it's the trusts themselves, selling off and buying back potentially as a catalyst, but it's just an oversupply issue where what these trusts were set up to do is not as attractive to investors anymore.
Brilliant, thank you. One that is inside your portfolio is Georgia Capital, and you mentioned that they're selling off assets. How do you see this playing out in the long run?
Yeah, I think it's one of those situations where you've got a manager who really understands the stock market, and if you talk to the manager, he will say the market is telling us to sell our assets and buy back shares or tender offers, or give that money back to shareholders. That's what the market's telling us. It's it's sitting at an incredibly wide discount, and they've put their money where their mouth is. They sold that beer business, and they're using the proceeds of that to buy in shares. So I think they will continue to do that up until the point that the trust trades at a much narrower discount than it does currently. But that strategy has been one that that they've decided on, and I think it's absolutely the right strategy. So it proves the NAV, and it releases capital for shareholders. So I think it's the right strategy. It will continue up until the point where things change.
Great, thank you. A little bit of an easier question. What do you see the optimal size of the vehicle being for Migo?
Right. I'll historically, probably I've always felt, but we've never been beyond across the range of mandates, sort of 160, 170 million, and that's not caused any liquidity problems. I've always thought that the answer is probably somewhere around about 250 million. Beyond that, you can start to get liquidity problems, but then you become the catalyst. But because you've got big enough position to buy stakes to make a difference, and then once you go beyond that figure, you tend to go down more an activist route. Although obviously there's a certain extent with the move to AVI, that may well happen sooner. So yeah, difficult to tell, but that's sort of figure, where before it gets too big and you end up with liquidity problems in what is a fairly liquidity challenged market.
Right, we look like we're coming up to the last few questions, and they seem to be based more around AVI. Obviously, you're well settled there now, having been there close to a year. How are you seeing life at AVI, and are you seeing more opportunities now that you're housed there?
Yeah, so the benefit, one of the big benefits of moving to AVI is that they both run trusts and invest in trusts. So you have, it's what we describe collaborative and collegiate. Obviously, what we're focusing on is much smaller end of the market in comparison to AVI Global. We have, I think it's 3 cross holdings between the 2 trusts, and so that's Chrysalis, Cordiant, and Oakley, and at that point, for those companies, that's very helpful. They have much bigger stakes, and therefore, that's helpful in terms of engagement. And then otherwise, it's the additional resources that we have, their knowledge and expertise in engagement that we can use, and so I think there's an awful lot of positives for especially at this point in the investment trust cycle as well for Migo's move to ABI.
Great. Well, you actually answered the last couple of questions within that, so thank you very much. They were just based on what's the crossover in the portfolio, and are you able to have more of a collaborative side of things in terms of activism, which you've already answered. So Nick and Charlotte, thank you very much for your time today, and I'd also like to thank everyone for dialing in today's call. If you have any further questions or would like to arrange one-to-one with the team, please email ir@frostshow.com. So thank you very much, everyone, and I will see you next time.